Could a trade war between two of the world's closest allies really come down to oil versus steel? That was the question hanging over Steelton, Pennsylvania, as former President Donald Trump addressed a cheering crowd at the U.S. Steel plant on May 30th, 2025. With unmistakable conviction, he announced his boldest move yet in a series of protectionist measures, doubling existing U.S. tariffs on imported steel from 25% to 50%, and extending that same 50% levy to aluminum imports. Standing beside executives from Pittsburgh-based U.S. Steel and representatives of Japan's Nippon Steel, fresh off a blockbuster investment deal, Trump framed the tariff hike as a victory for American workers. "We're going to bring it from 25% to 50%, he declared, his voice echoing off the cavernous factory floor. "Nobody's going to get around that. No one will be able to avoid it." Why the steel and aluminum tariffs matter. Tariffs are taxes imposed by one country on goods imported from others. By making foreign steel and aluminum more expensive, Trump aimed to revive U.S. production and safeguard factory jobs in states like Pennsylvania, long symbols of America's industrial might. But raising tariffs from an already lofty 25% to a punishing 50% risked rattling supply chains, inflating costs for U.S. manufacturers, and provoking retaliation from trading partners. The timing of the 50% increase was impossible to ignore. It came just days before the new rate was set to take effect on June 4th, 2025, and immediately sent shockwaves through North American markets. Canada, the United States' largest supplier of both steel and aluminum, bristled at what Prime Minister Justin Trudeau's government called a direct attack on Canadian workers. Over the past 2 years, Canada had lobbied intensively to ease U.S.-imposed barriers worth more than $35 billion in annual trade. But Trump's latest escalation threatened to render much of that cross-border commerce unprofitable overnight. Canada's counterpunch, the oil trump card. How did a dispute over metal tariffs morph into discussions of oil exports? Canada's answer lay in its own economic strength and vulnerability. As the world's fourth largest crude oil producer, Canada ships about 4 million barrels of oil per day to the United States, translating to roughly $103 billion in annual sales. Many American refineries, especially in the Midwest PADD2 region and on the West Coast, are configured specifically to process Canada's heavy crude, a resource not easily replaced, faced with steep new duties on its steel and aluminum. Canada's leaders quietly revived talk of using energy exports as leverage. Prime Minister Trudeau's advisors, echoing comments once deemed too radical for public debate, floated the idea of throttling oil shipments to the U.S. "If you strangle our steel and aluminum, we can turn off your oxygen," became the unspoken metaphor. On paper, cutting Canadian oil could deliver a painful blow to U.S. refinery operations, drive up gasoline prices at the pump, and disrupt the chemical sector. With Venezuela under U.S. sanctions and Middle Eastern heavy crude carrying logistical and geopolitical risks, Canada stood out as a vital and dependable supplier. Some analysts forecast that a significant reduction in Canadian oil could raise U.S. gasoline prices by 30 to 40 cents per gallon and inflict $35 billion in annual costs on the American economy. The feasibility of a Canadian oil embargo, yet Canada's own dependence on U.S. demand, posed a dilemma. More than 90% of Canadian crude is sold south of the border, meaning any cutback would slash Canada's export revenues and potentially destabilize its own economy, particularly in Alberta, where energy jobs and provincial finances are deeply tied to oil. Recognizing this, Ottawa and provincial authorities accelerated efforts to diversify export routes. Key to that strategy is the Trans Mountain Pipeline expansion, boosting capacity from 300,000 to 890,000 barrels per day by 2024. That project, along with new LNG facilities on Canada's Pacific coast, aims to open Asian markets to Canadian crude, a market that 5 years ago was virtually non-existent. In 2024, Canada exported about 200,000 barrels per day to Asia. Proponents believe that figure could grow substantially as infrastructure and shipping agreements mature. However, full pivoting to Asia faces hurdles. Negotiating long-term contracts, coping with higher shipping costs, and waiting for pipeline tariffs and port fees to stabilize. Currently, Trans Mountain operates at roughly 77% capacity, with projections to reach full throughput only by late 2025. Thus, in the short term, Canada's ability to redirect large volumes of oil away from the United States remains limited. Trade war chess moves. The resulting standoff resembled a high-stakes chess match. Trump's tariff move put Canada on the defensive, threatening to choke its steel and aluminum sectors. Canada's oil card counter offered the potential to inflict equal or greater pain on the US, but would Canada really follow through and cut supplies? Or would the mere threat be enough to force Washington to reconsider? In Ottawa, some officials argued that even a modest reduction or quota on oil shipments could demonstrate resolve and invite US concessions on tariffs. Others cautioned that any significant cut risked harming Canada's own energy sector, driving unemployment in Alberta, and complicating relationships with Asian buyers not yet ready to absorb large Canadian volumes. Meanwhile, US industry groups warned that cutting off Canadian oil would create logistical nightmares. Refineries unaccustomed to sourcing heavy crude from elsewhere would face costly retrofits or reliance on more expensive suppliers. Gasoline and diesel prices could spike, inviting political backlash against any administration perceived to have engineered the crisis. Potential outcomes and stakes. Several scenarios emerged. Mutual escalation. The US keeps tariffs at 50%. Canada cuts oil exports sharply, US raises tariffs further, or imposes other trade sanctions, triggering full-blown trade war. Both economies suffer, higher consumer prices, disrupted manufacturing, and stock market volatility. Diplomatics compromise behind closed doors, Canadian and US leaders negotiate an agreement, US scales back tariffs to a lower rate, or offers targeted exemptions for Canadian steel and aluminum. Canada maintains steady oil flows and continues pursuing diversification at a measured pace. Both sides declare victory and public tensions subside. Unilateral retreat. Either side blinks first. The US drops its increase to 35% or 25% after facing domestic pressure over rising gas prices. Canada quietly backs off its oil threat, recognizing the practical challenges of finding alternative buyers in the short term. Prolonged showdown tariffs remain at 50%, and Canada sustains mild production curbs. Each side seeks new markets. The US ramps up domestic steel production and explores alternative aluminum sources. Canada accelerates export capacity to Asia. Supply chains reconfigure over months or years, creating winners and losers among smaller producers and importers. Why this matters for workers and consumers. At its core, the dispute underscores the risks of over-reliance on a single market and the fragility of global supply chains. In Canada, steelworkers and aluminum fabricators fear mass layoffs if the US tariff renders their products uncompetitive. In the US, manufacturers from automakers to construction companies worry about skyrocketing input costs and potential plant closures. Consumers on both sides face the prospect of higher prices, whether at the pump, on the car lot, or in the goods that line store shelves. Political leaders, mindful of upcoming elections, must weigh the economic fallout against the political gains of protecting domestic industries. A race to see who blinks first. As this game of economic brinkmanship unfolds, both Ottawa and Washington publicly vow not to yield. Trump has famously stated, "We have to win or we lose," while Canadian officials insist they will defend their workers and strategic interests. Yet behind the rhetoric lies an uneasy mutual dependency. For Canada, the pipeline to Asia offers a path to strategic autonomy, but not an immediate lifeline. For the US, abundant domestic steel capacity might lessen dependence on imports over time, but in the short run, vacating Canadian metal and energy would be a painful disruption. Conclusion, a fragile balance. In the end, trade wars often end. Not with decisive victories, but with negotiated compromises born of mutual pain. The United States and Canada share the world's largest bilateral trade relationship, built over decades on the principle of seamless cross-border commerce. A sustained rupture would harm both economies, shake investor confidence, and tarnish diplomatic bonds. For now, the stakes remain high. Will Trump's 50% tariffs on steel and aluminum hold? Or will Canada's threat of oil restrictions force a rollback? Will domestic political pressures tilt one side toward conciliation? Or will this episode mark the beginning of a more protectionist era in North American trade? One thing is certain, the question posed on that factory floor, could oil become the ultimate countermeasure to steel tariffs, will echo in boardrooms and legislatures on both sides of the border for months to come, as Canada races to diversify its markets and US consumers brace for potential price hikes. The fragile balance of one of the world's most integrated economic partnerships hangs in the balance.